Hi, and welcome to this week's look back at the stories that have affected or are affecting the market so far. And we're going to start with the FTSE. And the FTSE seems to be back on track, but the 8,000 point level does seem to be out of reach. Now, in February, as I mentioned there, we reached 8,012, and we saw at that period of time a similar level of euphoria from traders, analysts, commentators alike, to back in the early summer of 2021, where the FTSE broke the 7,000 mark. Now, this has all been happening against a backdrop of supply chain and logistical difficulties, obviously rising inflation, tech stock crashes in the US, and a period of time where smaller, relatively unknown companies were using SPACs to list on the markets, avoiding some of the more typical sort of paperwork that you had to go through. So all that was going on, but it seems the more traditional companies in the FTSE 100 have been performing remarkably well. Now, the lofty heights of 8,012 was a result of a steady upward trend, but that was broken by a sudden fall in confidence in bank stocks following the Silicon Valley Bank collapse in the States. UK bank stocks suddenly dropped due to fears of contagion from the US, and obviously that wasn't helped by the demise of Credit Suisse, at the time the second largest Swiss bank. Over £70 billion was wiped off the value of the FTSE basically overnight. But since all of that happened, a month has passed, and there certainly seems to be no contagion for UK banks. And the FTSE has been steadily climbing, with traditional stocks certainly in favour. The banking crisis has stopped thoughts of 8,000, with a drop from over 7,900 to 7,410 on March the 10th. But from March the 24th to the 18th of April, we've gone from 7,405 to 78.79. Little blip on Monday, but that's 475 points in under a month gained by the FTSE, and that's not to be sneezed at. The question is, will this positivity continue? So whilst it's positive news for the FTSE, we're going to turn our attentions across the pond now. And the NASDAQ does seem to be in the doldrums despite optimism around the big tech earnings. It's quite clear it's not performing as well as traditional indices such as the FTSE. We've just spoken about that. Certainly we've seen some high volatility over the last sort of year, 2 years really. And there's a huge impact on that volatility from the tech stocks. We've covered the stories about techs being up and down like nobody's business the last 12 months or so. But we've seen Tesla and Netflix announce their figures this week, and many commentators declared them as impressive. We actually saw Tesla fall 6% though after their results came out, mainly due to a drop in margins, and that's despite revenue being up 24% in annual terms. But it's still an increasing feeling of confidence in tech stocks, with other big names such as chipmaker Nvidia performing particularly well at the moment. But the NASDAQ indices don't seem to be responding quite as many would hope. Now, over the last couple of years, we have seen some quite large swings, but the boom of online commerce due to lockdowns back in sort of 2021. And that was replaced last year, though, by fear and a big fall in confidence over these tech stocks. Last year, we saw the composites, that's the sort of the 250 biggest stocks there, fall from 13,619 this time last year to just 10,646 in June. Now, it did try and bounce back a couple of times, the NASDAQ Composite and NASDAQ 100, they did try and bounce back, but those were both followed by two quite major elongated slumps. So volatility is still there, and certainly I think the results coming out of certainly the big tech stocks in the coming days and weeks are going to be scrutinised probably more than they ever have been. But are they going to turn the NASDAQ round? Are we going to see some form of recovery? I think it's fair to say volatility will remain, so don't forget your risk management techniques. Okay, so we've had a look at the UK in terms of the FTSE 100. We popped across the pond and looked at the NASDAQ. What about Europe? Well, European stocks are at historic highs. Now, this week, we saw a high of 4416.8 on the European 50 index. That's higher than last autumn's highs. So the UK is doing okay. European stocks certainly seem more bullish than the US, but why? Well, obviously, as mentioned before, we've had the banking crisis. And despite Credit Suisse going bust, being bought out, however you want to look at it, it certainly seems to have had a lesser effect this side of the pond than in the US. There's also in Europe been strong performance in certain sectors. We look at luxury goods and aircraft manufacturing in France, for example, and automotive manufacturing in Germany. Perhaps drawing some parallels there, slightly more traditional industries. But then Friday morning sees the release of PMI data in both Germany and France. We think this will probably have an impact, as you would expect. Could, of course, push it up towards new highs again, which would be a real bonus. Or it could lead to a correction. If it is the correction version, then we're looking probably the 43.20 level. Hopefully will support the European stock market, as well as the median line of the rising channel, which is shown in blue. I think it's certainly going to lead us to an interesting end of the week. So keep your eyes on those figures. They're definitely going to have an impact. Where we go probably won't become clear until the start of the trading week next week. Get a little change in tack now, away from the indices. We're going to look at the energy markets, and of course energy crises, cost of living crises abound. But we're seeing an abnormal balance in the energy markets currently. Now, the NYMEX oil future price for a contract at the start of this week was $82.48. At the same time, on the same exchange, natural gas future was $2.15. Now that's the ratio of oil to gas was 38.36. We take the 82.48 and we divide that by 2.15. And last Friday, that ratio was at 40. Now these are levels that haven't been seen since May 2012. In fact, for many years, the ratio's not really exceeded 25 to 30. But we saw a mild winter in the US, which has led to a fall in the gas price, demand not there as much as expected. And we've also seen recent OPEC Plus decisions, for example, on oil production caps. This has pushed the ratio up. So we've got lower gas price than expected and lower oil production. But it may well be on its back to more familiar levels though. Now the daily natural gas chart shows potential bullish signals. One being the false bearish breakdown of the low of the year. And secondly, a bullish gap at the week open. The last two bullish candles indicate demand is dominating. The price may well reach the psychological level, that's at 3, of $2.50, which was both support and resistance in March. And it's also worth noting, of course, that according to a forecast of the US Energy Information Administration, the gas price for 2023 should be an average of about $3.13. That's almost 40% up from its current values. So indications there that we may well see that ratio dropping to more normal levels, perhaps the gas price coming up. But of course, with all the geopolitical unrest in the world at the moment, you can't discount the impact of further actions in the oil markets. So keep your eyes and ears opened, and it's important to understand how prices of one commodity can affect the price and demand for others. We wish you luck with the trading in the week ahead.